in the past 18 months. As inflation surged and the Federal Reserve raised interest rates, the tried and tested methods of saving money made a triumphant return. People flocked to government I-bonds, high-yield savings accounts, and dependable bank certificates of deposits, seeking better returns on their hard-earned money. But for those who didn't make the move to greener financial pastures, fear not. Financial advisors reassure us that there's still time to give our savings a much-needed boost. As the Federal Reserve gears up to announce yet another quarter percentage point increase in its benchmark rate, many are wondering what lies ahead. While higher rates might make borrowing money for homes or cars more expensive, they also promise to make yields on savings more attractive. This presents an opportune moment for savers who might be worried about missing out. Locking in higher CD rates now could prove beneficial if rates take a downturn in the coming months and years. Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So before we get into today's videos, hit that subscribe button and turn on post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button. Leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching, and now let's dive into it. The world of personal finance has seen quite the shakeup over the past 18 months. In the face of soaring inflation and the Federal Reserve's response of increasing interest rates, people have sought solace in traditional methods of saving money. With gusto, they flocked to government I-bonds, high-yield savings accounts, and steadfast bank certificates of deposits, all in pursuit of better returns on their hard-earned cash. For those who hesitated to join the trend, financial advisors offer a glimmer of hope. There's still time to give your savings a much-needed boost. But what's on the horizon as the Federal Reserve gears up to announce yet another quarter percentage point increase in its benchmark rate? The answer lies in the potential allure of attractive yields on savings. Higher rates may make borrowing money for big-ticket items more expensive, like homes or cars, but they can also breathe new life into your savings. So, is this the moment savers have been waiting for? An opportunity to seize higher CD rates, safeguarding their future in case rates dip again? Lou Liberatore, the director of research at Alexandria Capital, an investment and wealth management company, believes so. He asserts that CDs, despite being considered a more old-fashioned savings approach, have suddenly become alluring across generations. Offering higher interest rates compared to regular savings accounts, CDs do come with a catch. Savers must commit to locking their cash away for a specific period, usually 6 months or a year. Early withdrawal may incur fees, but there are no penalty CDs available, though they typically yield less interest in exchange for granting the flexibility to withdraw funds after a short period. And fear not, as CDs are insured by the Federal Deposit Insurance Corps for up to $250,000. Bankrate reports that as of July 25, CDs are yielding up to 5.3 for one-year terms and 4.5 for five-year terms. Mark Hamrick, senior economic analyst at Bankrate, believes that higher rates are here to stay, making CDs a compelling choice. Liz Young, head of investment strategy at Sophie, echoes this sentiment, suggesting that the 5-year return could prove advantageous if rates decline in the years to come. So, how can one chase higher yields with CDs? Financial advisors recommend several strategies for short and longer-term returns. Savers can compare rates from different banks and credit unions, and consider the benefits of a CD ladder, purchasing a series of CDs with progressively later maturity dates. This way, a portion of their savings matures each year, offering flexibility to reinvest or spend, adapting to changing rates. Alternatively, the barbell strategy splits the investment into two buckets, one for longer-term savings, like a CD, and the other for shorter-term options or investments. Isaiah Hedden, a 39-year-old video editor from Virginia, shares his success story with CDs. He seized an opportunity presented by Capital One, depositing $2,000 into a one-year CD when the bank advertised a remarkable 5 rate. As he was saving for a camera and didn't need immediate access to his funds, this decision has proven beneficial. When his CD matures next year, He expects to have around 2,096. Isaiah plans to roll his money over into another competitive CD if rates remain above 3. Of course, the appeal of CDs might not be universal. Their practicality largely depends on the timeline for needing access to the funds. If immediate accessibility is crucial, high-yield savings accounts might be a more suitable choice, as withdrawing money early from a CD can incur penalty fees. Alternatively, for investors living in high-tax states such as New York or California, treasuries might be a more attractive option. Unlike CDs, treasuries are generally exempt from state and local taxes, offering another dimension to the decision-making process. One piece of advice from Ken Tuman, senior industry analyst at LendingTree, is to pay close attention to CD maturity dates. Once a CD matures, savers have a limited window of time to decide their next financial move. Waiting too long might lead to missed opportunities, less attractive rates, and the risk of losing out on potential gains. In this dynamic financial landscape, savers must stay vigilant and explore their options. But as the future remains uncertain, the question arises, is now the time for you to embrace the allure of CDs, safeguarding your savings for potential financial storms? What strategies would you employ to chase higher yields? Share your thoughts in the comments section below. And remember to subscribe to the channel to stay up to date on global economic news. See you on the next video, and please like and share if you enjoy our content.